Hey traders, in this video we're going to talk about trading without charts. Stay tuned. Hey guys, warm welcome to you. Alright, so you may have heard of many traders who trade without charts, and this is something that I was very into many years ago, and this is from a day trading perspective. I'll be very focused on intraday trading and scalping, and it served me very well. Now, however many years are on, 19, 20 years on, I have developed my style and strategy because I've got a different trading account size, because I have a different experience, because I have a different lifestyle, all this stuff, into more of a hybrid model of swing and scalp into one. So I kind of look for a 2 or 3 day hold on my trades, but my entry is very much still leveraging on that experience I have with trading without charts and reading the tape and reading the price action on a short-term basis. Combine the two, it works for me. Everyone's different though, guys. You know, whatever strategy works for you, keep doing it and keep trying to improve at it. However, something I want to point out is, what does it actually mean when you say you're trading without charts? So trading without charts is really, in one way, it's really just looking at the order flow coming in through the order book and through the time and sales, and looking at level 2 as well to a certain extent. So really the first thing you do is you use a chart to define your levels. Now not necessarily, you might say, okay, well I know the all-time high of this stock is $100. I know that there's a key level here, but most of the time people are going to use charts to define the levels of interest, the areas of interest, maybe at support levels. So you're automatically going to look at your daily chart and go, you know what, there was a market's come back down, there was a big support level here, this is my area of interest. But then your charts go out the window. You're not interested in the charts then. Your chart is just to highlight where you should be focusing your effort, because you're constantly looking at tape all the time. You just go nuts, you just go crazy. And that could be on an intraday basis, guys, or a swing basis, by the way. And then you set alerts. So you set alerts and say, hey, want to be alerted to this stock or this futures contract or this currency pair at this level. Great. Right, then the level comes up. Right, now it's time to look at the short-term price action, the tape. This is tape reading on a very short-term basis, and kind of get a feel for what's going to happen next. So you might say, you know what, I think this may well bounce off it, or I think I'm looking for a breakout through because I feel this was a head and shoulders here, or it's a fake out here. I'm looking for a target here. I want to see if we break through that support level. I want to try and feel the response of the market. And so this is when you'll watch your tape, you'll watch your price action, you'll watch how the orders are coming through the order book. One way, you don't necessarily have to do that, by the way, guys. That's like going into extreme depth of looking at level 2 and how the level 2 is positioning and how time and sales is running. But what's more interesting, I think, and there's nothing wrong with that, and that's really a good skill to have. I don't think it's essential. I think you can do 80% of that just by looking at how price changes, how the bid and offer changes, without going that extra depth of level 2 in the sales. So what I mean by this is, okay, let's imagine this level is $50 for whatever argument's sake. So you see it print $50, 49, 49, 50, 50, 49, 50, 49, 48, 47, back up. You start to see how the price, and you start to feel how price is responding when it goes through the level and back up. So does it make a couple of prints through? Does it then hold and do another shudder? Does it rock back? Does it pause? How long does it take before it prints a new level lower? Does it print a new level lower, then immediately run back up? Does it hold at a level, hold at a level, hold at a level? Does it do this? Does it, all this stuff is going on in your mind. You're getting to feel how price is responding to that. Now, if you're looking at a chart, you probably see it as a solid candle, or a candle, if I can say candle, a candle with a wick, like we'd do on a 3 minute or whatever it is. But if you're just watching the tape and the price action, you start to feel the price changes. How quickly does price change? So, you're looking for momentum. Is it momentum through? Is it exhaustion through? Is it, now we start to look at the speed, the size, and the response. So what I mean by this is, it's more on a broader scale, but I just want to touch on it briefly here. The speed that we go through a level, do we go bang straight through a level? Are we printing, or are we just plodding through like 1 print, 2 print? You won't see that in a candle. You won't see it. If you have a 3 minute candle, 1 minute candle, let's say it does 2 prints at the low and then comes back. There's no difference. We're going really low and then pushing back and then low again and pushing back and low again and coming back up. You're not going to see it on 1 minute. All you're going to see is the lowest print, the close print, the high, and the open for the 1 minute candle. So the speed of the price is moving through a level, a key level. And that's the response to the price. Is it a response? Is it rejected straight away? Does it hold at it? How does it respond to it? And the size as well. If you're going to go in depth, we should say you don't need to. If you're going to go in depth and start looking at time and sales and tape and stuff, you start to look and see what sort of volume do we have coming through. We've got smash loads of orders hitting that bid and it running right through. But then, what's the response of that? If we see size and that happening and you get a cascade and it still holds at lows, maybe this is going to be the break. Maybe this is the one you've been waiting for. If you get that, then you get an immediate flush back up, immediate bid. Wow, that's just the stop orders being pinged. You probably don't want to get involved in that until later. It's probably still a lot of buyers there holding that, a lot of demand stopping that from going lower. So there's all these kind of things that you're kind of trying to look at. So trading without charts is very much a feel. It's very much understanding in your mind and feeling how price is responding to these different actions and levels. And to me, the key, and guys, I'm trying to keep this video short, it's a massive topic. This is a kind of complete 10-hour topic in itself. But just to give you an overview, you know, what we're trading without charts is really about getting a feel for how price is moving. If you look at the olden days, like Jesse Livermore and all these kind of guys who were trading back in, when was this, Livermore 30s, I think he was, wasn't he? You know, they were literally thinking about price, and that was a higher time frame, so he was seeing stuff coming through. But at the same time, he'd be saying stuff in his book like, oh, you know, it just couldn't get through the 50, or it would get through the 50 level and would run on, then come back straight away. Every time it would go lower, it would get bought. Every time it would get lower, it would be bought straight away. And that is, you know, response to a dip. The response to the dip is immediate bid with size and pace. So dip, dip, bang, bid back up. You know, that's strength. Dips and it holds and starts creeping back up slowly. Maybe the buyers aren't as aggressive. So response to things is super, super key. Speed, size, and you get to start to feel the momentum and the exhaustion. So that's trading without charts, guys. Very, very brief summary. Hope that's helped. If it has, you know, a like and a share and a subscribe and all that other good stuff is much appreciated. I know you guys do, and I appreciate all your support. Take care, guys. Keep your risk management. See you next one. Bye bye.